If you look at the official data, the global bond market appears to be functioning normally. The auctions are clearing, the yields are volatile but contained, and the headlines assure us that demand for sovereign debt remains robust. But if you strip away the layers of obfuscation and look at the raw transactional data from the last 6 months, you see a terrifying anomaly that the financial media is terrified to report. We have reached zero hour. This is the theoretical singularity in economics where the entity issuing the debt becomes the only meaningful buyer of that debt. The United States Treasury, the European Central Bank, and the Bank of Japan are no longer operating in a free market. They are operating in a closed-loop system of self-see cannibalization. The bond market, once the deepest and most liquid ocean of capital on Earth, has evaporated. What remains is a mirage maintained by a pumpkin village of high-frequency trading and regulatory compulsion. To understand why this is happening now, you have to look at the failed auctions of late 2024 and early 2025. In a healthy market, when the U.S. Treasury needs to borrow $100 billion, it auctions off bonds. Investors from around the world, pension funds in Tokyo, insurance companies in Zurich, and sovereign wealth funds in Riyadh show up to bid. They buy the debt because they view it as a safe asset. But starting in late 2023, these buyers began to vanish. The bid-to-cover ratios, the metric that measures demand, collapsed to dangerous lows. The tail on the auctions, the difference between the expected yield and the actual yield, widened. The market was screaming no. In a true free market, a failed auction would result in interest rates spiking to 10% or 15% to attract new buyers. But the U.S. government cannot afford 10% interest on $36 trillion of debt. It would consume 100% of tax revenue, leading to immediate state bankruptcy. So the zero-hour protocol was activated. This is the unwritten rule that forces the primary dealers, the big banks like J.P. Morgan, Goldman Sachs, and Krupp to step in and buy the debt that nobody else wants. They are legally obligated to act as the bidder of last resort. But here's the catch. The primary dealers are already full. Their balance sheets are clogged with losses from the bonds they bought in 2022 and 2023. They cannot afford to hold more toxic paper. So where do they get the money to buy the new debt? They get it from the Federal Reserve. Through a complex web of repo facilities, repurchase agreements, and liquidity windows, the Fed lends money to the banks who then use that money to buy the Treasury bonds. The Fed is effectively printing money, handing it to a middleman, the bank, and telling the middleman to buy the government's debt. It is backdoor monetization. It creates the illusion of organic demand. The news headline says Treasury auction strong, but the reality is that the government just bought its own debt using a proxy. It is the financial equivalent of a restaurant keeping itself in business by having the owner eat every meal and paying for it with money taken from the cash register. This closed loop creates a zombie market. The price of the 10-year Treasury bond, the most important number in global finance, is no longer a market signal. It is a managed price. It is a fix. Because the central bank is the marginal buyer, they control the yield. This destroys the information value of a market. Historically, rising bond yields were a warning signal from bond vigilantes that the government was spending too much. Today, the vigilantes are dead. The central bank has shot them. This removes all fiscal discipline from the government. Politicians know that no matter how much they spend, the zero-hour mechanism will ensure the debt is bought. This is why deficits are exploding even while the economy is technically growing. We are witnessing fiscal dominance where the central bank loses its independence and becomes a mere division of the Treasury Department, existing solely to facilitate government spending. But the most dangerous consequence of zero hour is the crowding out of the private sector. Because the banks are forced to use their balance sheet to store government debt, they have no room left to lend to the real economy. Small businesses cannot get loans. Mortgage rates stay high relative to treasuries. The credit impulse of the economy dies. We enter a strange paradox. The government is flooded with cash from the monetization, but the real economy is starved of credit. This is the Japanification of the West, but at a much faster speed. In Japan, this process took 20 years. In the US and Europe, it is happening in 20 months. The velocity of money collapses in the real world, while the velocity of collateral explodes in the shadow banking system. Furthermore, this protocol signals the end of the risk-free rate. For 100 years, the U.S. Treasury bond was considered risk-free because the government could always tax its citizens to pay the debt. But when the interest payments exceed the tax receipts, which happened in 2024, the math breaks. The only way to pay the debt is to print more money. This means the risk has shifted from default risk, not getting paid, to debasement risk, getting paid in worthless currency. Foreign central banks see this. This is why China is selling treasuries. This is why the BRICS nations are buying gold. They know that 0 hour means the bond is no longer an asset. It is a certificate of confiscation. They are exiting the theater while the primary dealers are forced to block the exits. The terrifying realization for the individual investor is that your entire portfolio is likely benchmarked to this broken number. Your stocks are valued based on the 10-year Treasury yield. Your mortgage is priced based on the 10-year Treasury yield. Your pension solvency is calculated based on the 10-year Treasury yield. If that yield is a lie, if it is being artificially suppressed by the zero protocol, then the value of every asset you own is also a lie. We are living inside a valuation bubble that is kept inflated only by the central bank is a willingness to consume the entire bond market. And like all closed loops, it works perfectly until it doesn't. The moment the printing press stops, or the moment the inflation generated by this printing becomes politically intolerable, the loop breaks. And when a snake stops eating its own tail, it starves. To grasp the inevitability of the trap we're in, you must look at the mechanical plumbing of the Federal Reserve. Specifically, a facility that most people have never heard of, but which has effectively been the life support system for the U.S. economy since 2023, the Reverse Repo Facility, RRP. You can think of the RRP as the excess cash buffer of the financial system. When the government printed trillions during the pandemic, that money had to go somewhere. It ended up in money market funds, which parked it back at the Fed and the RP, earning easy interest. At its peak, this facility held over $5 trillion. It was a massive reservoir of liquidity. For the last 2 years, every time the U.S. Treasury issued debt that the market didn't want, the system drained cash from this reservoir to buy it. The RRP acted as a shadow buyer, absorbing the supply of bonds without forcing bank reserves to crash. It was a magic trick that allowed the government to run massive deficits without spiking interest rates or crashing the banking system. But in 2026, the reservoir is empty. The RP balance has effectively hit zero. This is the 0 hour in its most literal sense. The buffer is gone. Now, every dollar of new debt issued by the Treasury must extract a dollar of liquidity directly from the bank reserves. Bank reserves are the blood pressure of the financial system. When they drop below a certain threshold, estimated to be around $3 trillion, the banking system begins to seize up. Repo rates spike. Banks stop lending to each other. We saw a preview of this in September 2019 when the repo market broke overnight, forcing the Fed to intervene. But this time, the scale is an order of magnitude larger. The Treasury needs to issue $2 trillion of net new debt this year just to keep the lights on. With the RRP empty and foreign buyers selling, the only entity left to absorb that $2 trillion is the U.S. banking sector. But the banks are already full. They're holding hundreds of billions of dollars in unrealized losses on their existing bond portfolios. The same issue that killed Silicon Valley Bank. If they're forced to use their precious reserves to buy more Treasury bonds, they will become technically insolvent. The system faces a binary choice. 1. Allow interest rates to rise. To attract organic buyers, yields would need to rise to 8% or 10%. This would instantly bankrupt the U.S. government interest expense and the commercial banking sector mark-to-market losses. 2. Yield curve control, YCC. The Fed officially pegs the price of the bond. They will choose option 2. They always choose option 2. Yield curve control is the formalization of the 0 hour protocol. It is different from quantitative easing QE. In QE, The Fed says we will buy 100 billion of bonds this month. They fix the quantity and let the price fluctuate. In YCC, the Fed says we will not let the 10-year Treasury yield rise above 4. They fix the price and let the quantity fluctuate. To defend the PEG, they must print infinite money to buy every single bond that the market sells at that price. If the market wants to sell 1 trillion, the Fed prints 1 trillion. If the market wants to sell 10 trillion, the Fed prints 10 trillion. The balance sheet of the central bank becomes the dumping ground for the entire world's unwanted sovereign debt. This transition to YCC triggers a phenomena known as the iron triangle of finance. You can control only 2 of these 3 things. 1, the bond yield, interest rates. 2, the exchange rate, currency strength. 3, the capital flow, free movement of money. If the U.S. chooses to control the bond yield via YCC and keep capital flows open to remain a global reserve currency, they lose control of the exchange rate. The dollar must collapse. It is a hydraulic inevitability. If you print infinite dollars to keep bonds expensive, the value of the dollar relative to hard assets, gold, oil, land must crash. This brings us to the social catastrophe of the protocol, the Kion effect. This is the economic observation that money is not neutral. When the Fed prints money to buy bonds from the banks, that new money enters the system at the top of the pyramid. The banks, hedge funds, and private equity firms get the money first. They use it to buy assets, stocks, AI tech companies, luxury real estate. By the time the money trickles down to the wage earner, prices have already risen. The rich get asset inflation. Their net worth goes up. The poor get price inflation, their grocery bill goes up. YCC accelerates this wealth transfer to a criminal degree. It effectively guarantees that the asset holders will be bailed out at the expense of the currency holders. It creates a K-shaped society where the line between the haves asset owners and the have-its wage earners becomes a concrete wall topped with razor wire. The stock market will hit all-time highs in nominal terms while the homeless population explodes. We're already seeing this. The Dow Jones is at record highs, yet food bank usage is at record highs. This is not a contradiction. It is the mechanism working as designed. The 0 hour ensures that the government can keep spending and the banks can keep trading while the cost is hidden in the degradation of the standard of living for the working class. But the most insidious victim of this protocol is the pension system. Pension funds are the captive audience of the financial world. By law, they are required to hold a large percentage of their assets in safe government bonds. In a free market, a pension fund manager would look at a U.S. Treasury bond paying 5% while inflation is 8% and say, no, thank you. That is a guaranteed loss. But under financial repression, they are forced to buy. Regulations like Basel III and Solvency II effectively mandate that institutions load up on sovereign debt to meet capital requirements. This turns the pension funds into the bag holders of last resort. They're being forced to buy the assets that the smart money and the foreigners are selling. The Fed buys the bonds to set the price, and the regulations force the pension funds to buy the bonds to fund the government. It is a circular firing squad where the retirees are the ones standing in the center. When you see your pension statement showing a safe allocation to bonds, you are actually looking at a portfolio of unpayable IUs that are being kept at an artificial price by a central bank that is rapidly losing control of the currency. The 0 hour is not just a technicality of central banking. It is the liquidation of the middle-class future to pay for the insolvency of the present. The illusion of stability is maintained only because the public does not understand the difference between nominal and real. The government will never default. They will pay every penny of the $36 trillion. But those pennies will be worth nothing. The 0 hour protocol is the engine of this nominal payment and real default. It is the mechanism by which they will strip the purchasing power of your savings account to keep the bond market from imploding. In the final section, we will look at how you can escape this trap. Because while the door is closing, it is not yet locked. There are assets that exist outside of this closed loop. Assets that the Fed cannot print and the pension funds are not forced to buy. Escaping the 0 hour requires moving from the inside money that is being debased to the outside money that is being revalued. The clock has struck zero. The time for theory is over. The implementation of the 0 hour protocol is not merely a technical adjustment in monetary policy. It is a declaration of war on the saver. For the last 40 years, the social contract of the West was built on a simple premise. If you worked hard, lived within your means, and saved money in a bank or a government bond, you would be rewarded with a safe, positive return. That contract has been unilaterally torn up in a regime of yield curve control and debt monetization. The saver is the designated victim. The central bank, yes, imperative is to keep interest rates below the rate of inflation to liquidate the national debt. This gap, the difference between the 4% interest you earn and the 8% inflation you suffer, is not an accident. It is a policy. It is a stealth tax known as financial repression. The government is effectively siphoning purchasing power from your bank account to pay down its unpayable liabilities. You're paying the debt, not through higher taxes, but through the slow, invisible evaporation of your life's work. This reality necessitates a complete inversion of traditional financial wisdom. The advice that worked for your parents, pay off your mortgage, buy bonds, save cash, is now financial suicide. In a world where the currency is being debased to keep the system afloat, being debt-free and holding cash is a losing strategy. The winners in the 0 hour economy are the debtors. If you borrow money at a fixed rate of 6%, to buy an asset that appreciates at the real inflation rate of 10% or 12%, you are effectively shorting the dollar. The bank is paying you to take the loan. The inflation erodes the real value of the debt faster than the interest accumulates. This is why the ultra-wealthy carry massive mortgages on their properties even when they have the cash to pay them off. They understand that debt is a hedge against currency debasement. They're using the 0 hour mechanism against the state. However, playing this game requires owning the right assets. The vast majority of the public is trapped in the financialization box. Stocks, bonds, and ETFs held in brokerage accounts. These are inside money. They are liabilities of the system. As we discussed, they are subject to rehypothecation, capital controls, and balance. To escape the protocol, you must move a significant portion of your net worth into outside money, assets that exist independently of the financial ledger. Gold is the primary vehicle for this escape. It is the only financial asset that is not someone else's liability. When a central bank prints money to buy bonds, they are diluting the currency. Gold, which cannot be printed, reprices to reflect this dilution. It is the anti-dollar. But the critical distinction in 2026 is physical possession. The paper gold market, ETFs, and futures is part of the inside system. It is leveraged and vulnerable to default. The 0 hour escape route is physical bullion held in your own possession or in a non-bank vault in a neutral jurisdiction like Singapore or Switzerland. This removes the counterparty risk. If the banking system freezes or the bond market collapses, your gold remains accessible. It is the ultimate insurance against the failure of the 0 hour loop. Bitcoin represents the digital flank of this escape. While gold protects against monetary debasement, Bitcoin protects against monetary capture. In a world of central bank digital currencies, CBDCs where the government can track and control every transaction, Bitcoin offers a parallel rail. It is a bearer asset that can be transported across borders in your head. The SARS 0 hour protocol relies on trapping capital inside the domestic system to force it to buy government debt. Bitcoin is the capital flight technology that allows wealth to exit the trap. The volatility of Bitcoin is the price you pay for its exit liquidity. The smart money views this volatility not as a risk, but as the chaotic repricing of a new global reserve asset being born in real time. Productive land is the third pillar. Farmland, timberland, and energy-producing real estate are assets that have intrinsic utility. People need to eat, they need to build, and they need energy regardless of what the currency is worth. These assets act as a pass-through for inflation. If the dollar collapses, the price of corn, lumber, and oil goes up. The land that produces them retains its purchasing power. Furthermore, land is a physical reality that cannot be hacked or deleted. In the zero-hour scenario, where financial abstractions become increasingly untrustworthy, tangible reality commands a premium. But the most dangerous trap for the individual investor is the passive index fund. Millions of people have their retirement savings on autopilot in S&P 500 index funds. They believe they are diversified. They are not. They are long the magnificent 7 tech stocks and the US dollar. The S&P 500 is heavily concentrated in companies that benefit from the financialization of the economy. If the zero-hour protocol breaks, if the bond market revolts and rates spike, the valuation multiple of the stock market will collapse. The everything bubble is built on the foundation of suppressed interest rates. When that foundation cracks, the passive investor will face a lost decade of negative real returns. You cannot passively invest your way through a sovereign debt crisis. You must be active. You must be contrarian. The zero hour also signals the end of global diversification via traditional means. Buying a global bond fund or an emerging market stock fund does not protect you. Most of the world's central banks are copying the Fed's playbook. The ECB and the BOJ are running their own zero-hour protocols. The entire G7 is a synchronized debt bubble. To truly diversify, you need jurisdictional arbitrage. This means obtaining a second passport or residency in a country that is not part of the G7 debt spiral. Countries in Latin America or Southeast Asia often have much lower debt to GDP ratios and healthier demographics. They are not forced to monetize their debt to the same extent. Having a legal foothold in a jurisdiction that treats you as a customer rather than a tax cow is a form of life insurance for your freedom. The psychological hurdle is the hardest part of this transition. We are conditioned to trust the institutions. We are taught that the Federal Reserve is omnipotent and that the U.S. Treasury is risk-free. Accepting that these institutions are insolvent and actively predatory requires a paradigm shift that is painful. It means admitting that the rules of the game have changed and that the referees are cheating. But denial is an expensive luxury. The people who refuse to see the zero-hour mechanism are the ones who will pay for it. They are the ones who will hold the bonds as they go to zero in real terms. They are the ones who will keep their cash in the bank as it loses 10% of its value every year. They are the liquidity that the system feeds on. The zero hour is not the end of the world. It is the end of an era. It is the end of the 40-year bull market in bonds and the end of the US dollar's unquestioned hegemony. But for those who prepare, it is the greatest opportunity in history. The transfer of wealth from paper to assets will create a new class of wealthy individuals. The new pioneers we discussed in previous videos. These are the people who understood the math, ignored the gaslighting, and positioned themselves in scarce essential assets before the herd panicked. The central banks are buying their own assets because nobody else will. This is the signal to leave the room. The exit door is still open. The gold price is the alarm. The Bitcoin block clock is the countdown. Don't be the one left holding the bag when the printing press finally runs out of ink.